Good morning to everyone and welcome to the Americas, a region which is facing some headwinds, but where we got everything it takes, the critical mass, the talent and the determination to keep winning over the long run. You can see consumer focus, you can see innovation and premiumization, and you will see an increased focus on productivity and cost efficiency to keep driving a strategic virtuous circle of a sustainable value creation. Zone Americas, Nestlé in the Americas is the largest region for Nestlé. It accounts for 45% of group sales and it's accretive, so that's roughly 50% of the cash flow. The zone managed, the part that I lead, 70% of that, 28 billion in sales, and you can see the weight of the two major US businesses, Nestlé US and Petcare North America, that account for roughly 2/3 of the total, which means that we got also a sizable business in Latin America with roughly 35% of total. You can see the categories. Petcare is not a white spot for us, it's a big green spot. And we got, and that's related, of course, to our US portfolio, a big frozen and a big ice cream business in the region, dairy, confectionery, coffee, being the most relevant categories apart from those three. To qualify the context in the region and to put it simple, I would say that it's deflationary in North America on the back of soft consumer demand, wage stagnation. Fundamentally, available income is still below pre-crisis levels and intense competition, of course, and LATAM is fundamentally recessionary, with Brazil for the third year in a row in a recession. Some light out of the tunnel, but which points more to a slow recovery than to a quick and strong dynamic in the region. The region has not yet fully recovered from the end of the commodity super cycle. Focusing on Zone Americas and the state of the nation, 31% of group sales, 40% of the total free cash flow, and I'd like to highlight again the third number, which is the share of our sales where we are number one or number two. 93% of our sales, we are number one and number two, and if I exclude confectionery US, it's virtually 100% of our sales where we are number one and number two, which highlights the strengths of our footprint in the Americas. The US business is resilient in a challenging environment. I'll come back to that, but transforming rapidly into an agile and productive platform. Mexico is strong despite the weak consumer confidence and has to do with what's happening in the northern border. Brazil is improving. Our business is improving, but strong macro headwinds. And I'd like to highlight as well, we don't talk so much about them, three geographies where we see potential for future growth. Argentina, 40 million inhabitants. The country is back into the global economy and we see opportunities. We got a good footprint there and good teams with good focus. Colombia, 50 million inhabitants on the path to the peace, which has everything it takes to really take off, and we are discussing as we speak and finalizing with the Cuban government our third joint venture, which will manufacture and sell coffee, biscuits, and culinary products in Cuba. The industry and consumer trends are not so different from what has been highlighted previously. Demographics have an impact, of course. The technology has an impact. We see significant shifts in retail with emerging retailers growing, but most of the growth going to e-commerce. Regulatory environment, especially in Latin America, is demanding. The downside is that this is fragmenting somewhat the markets, in the sense that every country has got their own schemes. The positive side is that it creates a level playing field where we can valorize our efforts to reformulate our products. Small is winning, but a good thing is that we got a nice mix of the global blockbusters of Nestlé combined with the small local iconic brands, and it's a lot about cost cutting, which of course we are embracing as well, but with the determination to keep investing in the business to sustainably deliver value creation. US is decelerating. That's the question that I got more or less every day. And why is that? And indeed now, not only in volume, but also in value, US food and bev retail is in negative territory. Has to do with, as I highlighted it, disposable income, which is under pressure. The fact as well that the government over the last years has massively reduced the food stamps program and the weak subsidies that impacts, of course, the business. There is no inflation in a no-growth environment, and in this respect, US looks a little bit like Europe and the dynamics in Europe. We see accelerated shifts in the way consumers shop, eat, and engage with the brands, and the growth of out-of-home keeps its dynamic, and now having passed the 50% mark. And that's also one thing which is not to be undermined. Basket size and impulsivity are down because the growing channels are not in favor, especially the convenience stores or the dollar stores, of big basket sizes, and certainly not in favor like e-commerce of impulsivity. Emerging retailers are the winners. The store openings are in the dollar convenience and drugstores. We see more e-commerce options being made available to the consumers, offering retail products, but also ready-to-eat solutions. And we see more omni-channel solutions being developed. So that's part of the context. And of course, the key question for us is, how do we grow and keep growing, and how do we deliver sustainable value creation in that kind of context? And of course, the concept of the strategic virtuous circle remains absolutely valid, relevant, and core to the equation. It's just that we have to put even more intensity in the current context when it comes to achieving efficiencies, productivity, taking every part of the equation end to end, and trying to get the most of our operation, sweating our assets, partly to fund the margin expansion, but partly as well to invest into growth platforms, to drive market share gains, because if we want to grow, and we want to grow in a no-growth environment, we need to gain market share, to drive category growth and expand our categories to deliver sustainable value creation. Growth is essential to the sustainability of the value creation. So that's the model that we are pursuing. And of course, there is a big, big focus on the cost equation. Simplification is top of the agenda. Operational costs are core to the equation. We are tackling as well our structural costs to get leaner and leaner, and we are also focusing on improving our portfolio. Achieving operational structural efficiency, this is the start of the strategic virtuous circle. This is the main focus of the teams as we speak, because we know where to invest. We got the innovations, we got the growth platforms. So the key point is to be capable to generate the resources to fund partly the margin expansion and partly investments into the growth platform. We got 100 lean value stream initiatives up and running in my zone as we speak. That means that every business unit has got a lean value stream initiative ongoing. Downstream, we are looking with intensity at the strategic revenue management, but we are looking as well at leveraging scale in procurement. That's part of NBE, and this is the famous Procurement Acceleration 2.0 initiative, and we have a specific project as well to improve our footprint in LATAM. Simplification, top of the agenda. Specifications, we have reduced 50%, but we want to achieve 100% smart and shared specifications by the end of 2020. That gives us the possibility to leverage our scale in procurement and as well to leverage our scale across our manufacturing footprint. Structural cost reduction, we got projects up and running across the continent in each and every market. We are working on one ISIT organization in North America from 4 today. And of course, NBE is addressing the end-to-end flows with critical focus on order to cash and source to pay. Portfolio strategy is part of the equation, of course, and we continue to focus on 6% total delivered cost improvement year on year. Part of that being cost reduction, part of that being cost avoidance. Let me highlight what we are doing specifically in the case of the US. That's the main geography, and there is a lot happening, of course. You see the same focus. In the structural cost reduction part, and I'll come back to that, we got the headquarter footprint being reorganized and being redesigned, and you can see the one ISIT structure and the one food division also being in the focus. There is a lot happening in terms of simplification, including leveraging digital into the workspace, but simplifying as well the reporting. And you see that we have been quite active in the last couple of years when it comes to portfolio management, with acquisition of Merrick, which is well ahead of acquisition plans as we speak. Great acquisition. Sweet Earth that we just acquired, the Blue Bottle, this equity stake in Freshly, and the confectionery review, which should lead to a conclusion by the end of the year. The total cost improvement in the US by 2020 over 2016 are in the range of 350 to 450, and we try to get to the highest level of the bracket, of course. A few words on the Nestlé US headquarter repositioning. That has been a major move. We were historically in the early 80s East Coast. We moved after the Carnation acquisition West Coast. We are moving back to the center of gravity of our business, our consumers, our customers. Our industrial footprint is primarily East Coast, so we get closer with this new headquarter in Arlington. It's also a better basket when it comes to talent attraction. We can see that we can recruit from a broader basket of talent. And let me report that the project is ahead of plan. That was a high-risk project in terms of its execution, but we are 6 months ahead of the timing initially scheduled. We got 70% retention of high potentials moving west to East Coast. That was not completely obvious. And when we look at total retention, we're in the range of 40 to 50%, which is twice above industry benchmarks. That means that we will have a nice combination of experience and fresh blood, and the payback of the project is now below 2 years. We are also focusing a lot on the ice cream business. It's very sizable, and we got a lot of assets in this activity with the DSD organization, and we target an underlying trading operating profit of mid-teen by the end of 2020. There is a big focus on the 3 C's: cost, cash, and cases. We are streamlining the factory structure and basically keeping in the factory people that have something to do with manufacturing ice creams. The people that have nothing to do with manufacturing ice creams will be leveraged above the factories. Lots of investments going into line level optimization. We are reducing the portfolio complexity, but accommodating also for some complexity because we need to cater for the needs of specific channels. We want to leverage more in-sourcing. We can supply some of the products internally, some of the products that we are buying from the outside. And we want to apply also the principles of smart recipes so that we can get some flexibility while making sure that we deliver, of course, the best quality at all times. So there is a big program ongoing in US ice cream, and I'm confident that we'll get to that level in that given time frame. Of course, those efficiencies that we are generating, part again will be channeled behind the margin expansion, but a big part also is to be focused behind growth platform. We want to stay relevant to our consumers. We want to be attractive to our consumers and to our customers, and innovation and renovation is, of course, essential to that equation. We got zone-wide priorities. We got also new health benefits innovation, and I estimate that in the next 3 years, we should have 3 billion incremental sales coming from those, and pet care, of course, is a big part of that equation, both in the natural segment and in Latin America, but we got also Dolce Gusto, and I'll come back to that, and many initiatives also across segments that should contribute to that equation. You see also the focus on the new health benefits innovation, and that's not only the US, many initiatives also are deployed in Latin America, and again, the opportunity market should bring us a couple 100 million additional sales in the same time frame. We are investing to win with millennials. We know the relevance of the target group, and we do it with a digital first engagement model, digital at the core. We invest in organic, plant-based, ethnic and local, and of course natural. All those resonate with this target group and are essential to our equation. You can see some of the initiatives that we are deploying as we speak. We are also investing into new consumption experiences. We see significant value creation being generated in the retail coffee arena. In the case of Blue Bottle, it's a different consumption experience. This is also an omni-channel opportunity between the retail cafes, between the direct-to-consumer e-commerce solution, and also the consumer packaged goods side of the business. Nestlé US has also many breakthrough initiatives in food. Food is a core category to the portfolio of Nestlé US. It's when you include everything, including chilled and dry culinary, a 4 billion sales business, so that's massive. That's center of the plate. We have a high ability to win with leading market positions across segments, and we got also a strong pipeline. We are investing into new territories. That's Sweet Earth with plant-based and a big focus on the millennials. That's Freshly, of course. And interestingly enough, we got also the concept of internal incubators. We are putting teams aside of the core Nestlé with working on their own to develop new approaches, and you can see that they have developed this Outsiders Pizza Company brand, and they are coming up with very disruptive and very different kinds of innovation. And we got also in the premium frozen food area this Wildscape concept, which is being tested and deployed as we speak. So we want to replicate what's happening in the ecosystem of the food industry with those small startups generating new ideas and coming up to the market with new ideas. We want to replicate as well internally with our own teams, but put aside and working as internal incubators. It's an interesting experience, and we'll report, of course, on the development of those. We are also recognizing that innovation takes place outside of our boundaries, and open innovation is core to our equation. So we got this Silicon Valley Innovation Outpost, which is connected to the ecosystem, and many good ideas are coming up from that side. We have also signed this agreement with Terra, Rabobank, and Rocket Space to work with startups in the food and agriculture area. And we got this 9 Square Ventures, which is making early stage equity small equity investment into startups in the pet care area. And that has been also bringing very interesting innovations or new ideas into the equation. Of course, investments is critical, but driving market share is also critical, and the channel piece of the equation is essential. We want to win with the winner. We want to grow with the high growth channels. We are developing as well new business models, cafe, ice cream bars. We are investing also in the grab and go solutions in retail, leveraging our Nestlé professional capabilities. We want to achieve e-business leadership and leverage on our marketing talent. We are, through the EFI recognitions, EFI awards, been recognized as the most effective marketeer in LATAM in 2017. Winning in e-commerce is critical. Most of the growth is coming from e-commerce. Pet care on the left, and you can see the size and the scale. It's frequent purchase, it's bulky products, so of course it indexes well in e-commerce. You can see our growth in first half, 97% in pet care North America. This is 1.3x the industry. We are leading in the space, but we want to keep leading in the space, of course. You see the growth in Nestlé US, 61%. On a smaller scale, of course, 42% in Mexico and 71% in Brazil. We recognize that there is something more different to be done with Amazon, and we are setting up, as we speak, a global Amazon acceleration team, which will be based in Seattle and which will work with the Amazon teams at making sure that we get the basics right on the one hand, but that's just the starting point, making sure as well that we drive new initiatives across our portfolio and globally across country boundaries. Pet care North America, of course, for Pet care North America, e-commerce and the leadership in e-business is essential. The business has doubled 97% in H1, and our vision is that it will triple, further triple, by 2020. We are investing in all the dimensions. We want to get the best in-class content. We are also developing our own direct-to-consumer models with the just right concept, customizing the solution to your pet. We are looking very carefully at the pricing equation because it's a sensitive point when it comes to channel management and e-commerce management. With the price transparency, we are customizing products and packaging solutions. So a bit of complexity, managing well the complexity will be essential on the manufacturing side, and we are getting ready for that. We are also working with Walmart on the store-based solution and the click and collect, and of course Amazon. I'd like to highlight that with Pet Finder, we got also a unique source of unique data on pet owners, which we are of course leveraging and which we will continue to leverage for the future. Few highlights on the Latin American markets. In Brazil, in spite of the crisis, we are focusing on growth platforms and have a great success. With Nescafé Dolce Gusto, you can see that it's already 100 million business in Brazil. It's been growing 41% CAGR in the last couple of years. And e-commerce, that's interestingly enough as well, e-commerce, so the direct-to-consumer model is 40% of our sales, so that's not that far away from the Nespresso numbers. And that's, of course, a lighthouse for the rest of the zone. And our ambition, our vision is that we should be able to achieve $500 million in sales with Nescafé Dolce Gusto by 2020. Nestlé Mexico is also investing in all dimensions, innovation, of course, in things that are relevant to the consumers, leveraging the Coffee-Mate platform, the modern cooking platform, organic, local recipes, lactose-free, and so on and so forth. They are pushing also very strongly the e-commerce capabilities and driving in a market where e-commerce is emerging, driving very strongly the channel development, but they're also working on new business models. It's very interesting to see what local creativity can bring. Look at Nescafé Dolce Gusto, which is a brand managed globally. They came up with that very interesting vending machine, which we are testing and deploying in a few outlets, and which is giving very promising results. We are working also on recipe personalization. We got a big dairy culinary business and a big culinary business, and of course being relevant with recipes is part of engaging well and giving recipe solution, engaging in the best possible way with the consumers. And of course we are also applying the principle of open innovation to make sure that we tap into the capabilities of the Mexican entrepreneurs. Value creation is critical, but we want to do it in a way which is sustainable. We have this long-term focus, of course, and creating share value is essential. So economic value creation, of course, is absolutely central, core to the equation, but we want to make sure that we do it in a way which is environmentally friendly and socially, and on top of that, in doing it, by the way, that also work for us on the economic side of the equation. So I just would like to highlight a few things that we are doing. In NHW, we are the continent which is probably the most exposed to obesity and overweight, so we pursue the aggressive reformulation of our products to make sure that we deliver at all times the best nutritional option for our consumers, but we put also a great emphasis on educating the children to healthy lifestyle and good nutritional habits. We are putting a lot of focus on youth employment, and you know that now it's been deployed globally, pushing the vocational training principles, readiness for work. We have alliances with hundreds of companies, and when it comes to the US, the focus is on the veterans, which have to be reintegrated into society, provide them with a qualification, and the job, of course, is the best way to make them part of society. We are working on water stewardship in each and every factory of Zone Americas, 150. We have, and we will have a water stewardship program, working with the community beyond the boundaries of our factories to make sure that we make the best possible use of the water resource. And there is a big focus on environmental sustainability, and it's of course economically sound as well, reducing greenhouse gas emission. We put a big focus on coal elimination, zero waste to landfill, and using also renewable energy like in Mexico, Brazil, and Chile. And we got our first 000 factory up and running in Brazil. This is zero carbon footprint, zero water withdrawal, and zero waste to landfill. So we got that, and of course that's a model that we would like to replicate. Winning is also winning with people and teams, and we are working on making every day the organization even more entrepreneurial, building up on the DNA of the organization, agile, flexible, connected. That's the name of the game. Safety is part of the equation. We want the best people, so being the best place to work and focusing on the youth, certainly one of the conditions to get the best people and the best teams on board. And you can see that we rank very, very well in those classifications. We focus on top and emerging talent, and we want also diversity to be part of the equation, and there the focus is on the management committees, operations, and sales, where we got generally a lower representation, but we want also to embrace and do something when it comes to disability. So those are the elements we got in our equation. If we look at the results over the long run, in the last years we have sustainably improved our bottom line. Trading operating profit has increased 110 basis points, and the zone is also accretive to the group, and with ups and downs, but over a long-term period we have improved our market share positions from a very, very strong footprint, 93%, 97%, if I exclude confectionery US, number one, number two positions compounded. That's an industry benchmark that's unique, and that's a great asset for the future. What are the key things to keep in mind? The zone is at scale. This is the biggest zone for the group. It's also accretive in profitability. It's dynamic. We got strong capabilities and scale across market. That's not only the US, that's Brazil, that's Mexico, that's Canada, that's Chile, Colombia, Argentina, and Cuba, which I mentioned. We are determined to address our cost structure, to be productive, to be cost efficient, to drive a sustainable strategic, virtuous circle of value creation, focusing investment on growth platforms, new channel, and new business models to be relevant and competitive in the marketplace, and the focus is on market share. Because to grow in a low growth environment implies to gain market shares and drive category growth. Volume growth in a context where there is low inflation or deflation is also very, very critical, and of course profitability. So those are the focus points for the zone, and we are determined to keep contributing to the group and to the equation that Mark has exposed in the morning. Thank you very much, and we may have time for a few questions.
Yes. With that, we open up for Q&A. And first question, please. Stuart, please.
I think you talked about a 50% reduction in specs in 2017, specifications in 2017 versus 2015. So my question is, how is there still so much to do here so long after the introduction of Globe, which was supposed to give visibility about this kind of area?
Yeah, Globe gives the visibility, but you have to have in mind that it's not because you got the visibility that you reduce the specs immediately. After the reduction of 50% of the specs and looking at the complexity and dimension of our business, we still have 10,000 specs. 40% of that is raw material, 60% is pack material. And what we want to make sure is that we got more shared specifications. We want also to eliminate unique specifications as much as we can to make sure that we can leverage our scale. It's not so much, the element is not so much in reducing the specs, reducing the impact on the working capital, than to make sure that we can concentrate our purchasing power and our focus on a reduced number of specs. And there is a lot of work to do, because when you eliminate specs, when you move from 10 vanilla natural flavor to 1, you need to, that's work for the R&D network. This is checking with the consumer that there is no impact on the organoleptic preference, and so on and so forth. So it's not that just you look at it, you decide, and you eliminate them. You look at them, you look at what is the best for the business going forward, and then you need to renovate, reformulate the products, and so on and so forth. So it takes a little bit of time. Probably the focus has been post-Globe in the first period more on the SKUs, and we move more recently into the specs, and to make sure that we can leverage our scale in procurement.
Jeremy.
Hi there. Can I just ask a couple of questions? So the first one is, you showed the graph with the volume and value growth in the US market. Is it your expectation that the sort of the 2017 numbers continue for the next couple of years, or do you think that we'll be looking at maybe sort of nearer flat rather than declines? And then the second question is on hard discount, which is something you didn't talk about so much in your presentation. So can you just talk about how you view that trend panning out over the next few years, and what your response to it is going to be? Thanks.
Yeah, so what we see, and actually the slide is quite illustrative. We see the trend, and we see where is the industry today. We see the dynamics also of the consumption. We see the deflationary pressure, so everything points to low growth, no growth environment for the foreseeable future. That looks very much like what we got in the rest of the developed market, but that doesn't mean that we cannot grow in that kind of environment. We can grow if we manage to be more relevant to the consumers, if we drive meaningful innovations, and of course, if we focus on the areas of the portfolio where there is still growth. It's not because the F&B retail industry is kind of flat today that some categories like pet care, for instance, are not growing. Pet care is growing 4% as we speak. So there are pockets of growth, and we need to focus on those. That's what has been explained in the morning. And we need to drive innovation and renovation, like we have been doing it in frozen food, to make our offering even more relevant to the consumer, even more appealing to the consumer, and make sure that in no growth, low growth environment, we can still grow. Looking at it, and I've worked 6 years in Europe, so I've been exposed to that kind of environment for a long period of time. at the end of the day, if you want to grow in a no-growth environment, there are not 20 ways you can do it. There are fundamentally 2 ways you can do it. One is to gain market share. The pie is not growing, so if you want to grow, you have to take a bigger share of the pie. And the second thing is to innovate, to make the pie bigger, to grow your categories. The two require something. They require intensity in the investments and productivity in the investments behind innovation and growth platforms. Hence, this concept of the strategic circle of value creation, the make or break for this, of course, to happen is being capable to drive efficiencies and productivity to both enhance margins and invest in future growth. Investments and innovation is future growth.
Patrick.
Patrick Schwendimann, Zurich Cantonal Bank. You have mentioned that you want to improve the US ice cream margin to a mid-teen level by 2020. What's the current margin then for the US ice cream? That's my first question.
It's below that.
I assume high single digit then, or?
It's below that. It's more in the single digit, high single digit.
Okay, and
level.
Second question, will be the US ice cream business still part of the Nestlé family, let's say in 5 to 10 years' time?
Well, if we succeed with that plan and if we bring that business to that level, and considering the capabilities we got, and if there is a path to beyond that, to being accretive to Nestlé, I don't see any reason why it shouldn't be a part of the Nestlé family. So if it delivers, if it's at par in terms of profitability or beyond, I don't see any reason why it shouldn't be. So that's the focus, that's the bet. And if we are confident to put it on the table, is that not only we have the ambition, but we got the plans and the path to get to there. And we should be already in 2018 at double digit.
Stuart Price had a question. Stuart.
Look, 2 questions regarding the U.S. business. In the case of pet care, you have Merrick's and Castor and Pollux brands in the specialty channel, but a lot of the growth in natural pet food is now taking place in the mass market. Do you need to bring those brands into mass, or do you just work with Beyond there?
Yeah.
And then in the case of sparkling water, you know, there's this explosive growth in terms of essence, what they call natural and sweetened sparkling water. You've tried to extend Poland Spring, Perrier, San Pellegrino into that category, but all the growth is taking place with brands like Polar and LaCroix, which are very, specific to a niche. How is your sparkling water strategy working out? Thanks.
So I will leave the sparkling water question for later today because I'm not the one managing that business. But yeah, there is big growth taking place in that category, and we are uniquely positioned. When it comes to pet care, I think we got a unique portfolio of brands that are well positioned according to different channels and very well suited to serve the needs of specific channels. We see that as a plus. Of course, in the ultra-premium natural organic segment, we got Merrick, which is the best of what can be done, and that's focused on primarily pet specialty and e-commerce as well. Part of pet specialty, so it's already big, only targeting part of pet specialty. So there is massive potential for expansion with Merrick, and we are discussing those plans as we speak. But we are also leveraging the rest of our portfolio of brands to integrate those natural, organic arguments, meat as the first ingredient. We make that big move on dog chow, which is our main premium brand for dog food, putting meat as the first ingredient. That looks obvious, but I can tell you that it's a massive effort from a supply chain standpoint and a massive deployment to be able to bring those arguments at scale. We got Beyond as well for Purina. So we got lots of brands that are well positioned, and I think we are uniquely positioned to leverage all those strengths, not only with one brand, but with our portfolio of brands and options to deliver sustainable value creation to our consumers, but also to our customers. And that's, I think, the recipe for long-term success.
Okay, I would say thank you very much, Laurent.